Dow Jones Industrial's down about 299 points right now. Okay, you've heard of girls gone wild? How about Fed gone crazy? President Trump said it. He's taking aim at the Federal Reserve, putting the blame for the market's plunge that we saw yesterday of 831 points on the Dow squarely at the feet of the central bank. All right, a live check of the December Fed funds futures, which indicate the odds of a rate hike. This is for December. Show they're not far at all from where they've been the past month. Right now, they're at 71.5% chance of a rate hike. Past couple of weeks, they've been around 80, 79. Now, if that fourth hike of the year comes to pass, are stockholders doomed, or is it too late to save investors? Either way, joining me now, Andy Brenner, head of fixed income at Nat Alliance, who says the Fed is doing what it thinks is necessary to keep our economy afloat, and Euro-Pacific Capital CEO Peter Schiff, who says the bear market has already begun. Peter, President Trump called it a correction, blamed the Fed. Is it a correction or a bear market, and should he be blaming the Fed?
Well, all bear markets start off as corrections. I think this one is probably a bear market. It's long overdue. But, you know, Donald Trump said that the Fed has gone crazy. He's wrong. They didn't just go crazy. They've been crazy for a long time. It was crazy to lower interest rates down to zero. It was even crazier to leave them there for as long as they did. The only sane thing they've done is to raise them back up. But what is crazy is for the Fed to believe that they could raise interest rates without pricking their own bubble, which is exactly what they've done. This is a bigger bubble than the one that blew up in 2008. And the crisis that is going to ensue is going to be far larger. You know, you mentioned earlier in the show that, hey, in the past, people were able to pay higher interest rates. That was true because we didn't have all this debt. Thanks to the Fed and cheap money, we have more debt than ever before. Individuals, corporations, the government is loaded up with debt. And as interest rates go up, that debt is unserviceable.
Andy Brenner, let's specifically tackle what the president said. He said the Fed is loco. In fact, he said the Fed is too stringent. He now suddenly doesn't want the Fed to tighten rates, although in 2016, during his campaign, he said, this is all political. Janet Yellen, who was the Fed chair, she's keeping rates super low to make President Obama look good and make the stock market look good. Total reversal here. Fed's going crazy. And then he even said, I'm not going to fire Chair Powell. I'm just disappointed. Well, I mean, the fact that he even said that really kind of people looked askance slightly. But you tell me specifically on this issue of the president blaming the Fed for yesterday's correction, where do you stand?
First of all, the president can't fire Powell. He's probably one of the few people in his administration that he can't fire.
I thought he could. I thought Federal Reserve Act says that the president can remove governors for cause.
Well, then that's new to me, because as far as I know, his term ends when it does.
Okay. Go ahead, Andy.
All right. As far as rates, you know, Peter's somewhat right in that the Fed's been raising rates. And, you know, as far as other things, I think the Fed has never seen a balance sheet unwind and raising of rates together. And I think that's causing the risk premia in the markets to rise. And I think that's hurting equities. I disagree with Peter on a bear market, but I do think a correction, 10 to 12 to 15% is coming. It is in the cards. I think the midterms will kind of reduce that. And I think as we get towards year end. But the president is clearly trying to get a scapegoat here. And the scapegoat's the Fed. You know, the president knew that equity markets are high. He's a markets guy himself. He's been trading markets back and forth over his 40-year career. So I think he's right in some respects and wrong in others in criticizing the Fed.
Peter, the president also, I believe, brought this up. He said, it's hurting me personally. I owe $300 million to Deutsche Bank of debt with interest rate that's hooked to the Fed policy. I'm paying a high interest rate. So he was complaining, almost, you know, making it like he's feeling, to quote another president, I feel your pain. But tell me where this all goes. And you really believe that this is a longer-term issue and the start of a bear market after what has been the second longest expansion in history.
Yeah, well, more important than a bear market, it's a recession. I mean, this is a bubble not just in the stock market, but the entire economy. So the Fed has distorted more than just markets. And the problem is this recession is going to be far more painful and, you know, far deeper than the one that we had in 08 and 09. Because it's also going to be accompanied by rising consumer prices. I think as Americans lose their jobs, they're going to see the cost of living going up rather dramatically. And so this is going to make it particularly painful. But, you know, one of the things I thought was funny that Trump said is that he was criticizing the Fed for raising rates too quickly because he said that he would rather have time to pay off debt first. And he was not referring to his own debt, but to the national debt. But the problem is Trump is exploding the national debt. Knowing that the Federal Reserve was going to raise interest rates, he signed on to tax cuts and spending increases. That is the worst thing to do when interest rates are going up. You don't want to go deeper into debt. You want to try to pay down debt. But the only way to pay down debt is to run a surplus.
You voted for President Trump. Not that I need to remind you
yeah,
at this
because
point,
look at the alternative.
you and I talk all the time. But yeah, I know. Look at the alternative. Go ahead, Andy.
One thing, I don't see a recession on the horizon. I mean, with GDP growth at 4% and unemployment low, I'm willing to give you a correction, but that's as far as I'm willing to give you. Interest rates still are historically low. And yeah, there's a lot of leverage in the system, and I can see a lot of bad things happening. And I'm more concerned about what's happening overseas. Emerging markets are down 25%. European markets are down 15%. Chinese markets are down 27%. I mean, there are a lot of bad things happening. Yeah, I think we're the least dirty shirt around, and I think that's. I think we're going to be okay. But yeah, I'll give you a correction. That part I'm willing to give you.
Peter.
Those markets are only down because everybody thinks the Fed's going to keep hiking rates and shrinking its balance sheet. You should be buying those markets. The Fed is eventually going to do it about face. But if you don't think a recession is coming, look at the auto sector. Look at the home builders. I mean, they're already flashing recession. Look at the financials. This is one of the longest economic expansions ever. It has required the greatest amount of monetary stimulus to produce it, and it's a gigantic bubble. If this whole thing is built on a mountain of debt, right, as interest rates go up, the thing collapses. And as the dollar goes down, the cost of living is going to go up. Wait till you see how expensive things are going to get in the United States, especially with these tariffs.
Okay,
they're just going to add to the inflationary pressures that already exist.
Sorry to interrupt.
I don't see how you can think that we're going to avoid a recession.
I'm looking now. We're going back down. We're down now 321 points. So let's see if we can make a run for the green line at least a little bit closer. I want to thank both of you, Andy Brenner, Peter Schiff.